Well, we'll go ahead and get started. First of all, welcome to 2017 World Dairy Expo. Today's seminar, Building a Stronger Relationship Between Dairy Owner and Dairy Banker, is sponsored by COMPER Financial. I'm Jim Moriarty, Director of Dairy for COMPER Financial, and I'm happy to introduce our speaker today, Art Mosner, Vice President and Dairy Team Lead with American Ag Credit. COMPER Financial and American Ag Credit are proud members of the Farm Credit System. Dairy owners require a stable and reliable source of borrowed capital from dairy lenders to maintain and grow their farms. Dairy lenders rely on dairy owners to operate profitably and make good business decisions to repay loans. The relationship between owner and lender can be complex, but it is necessary for dairy success. Art will examine the owner-lender relationship, propose ways to elevate relationships to the next level, and discuss why investing time and energy into the relationships can impact the profitability of a dairy. He will share ideas to strengthen the owner-lender relationship in a volatile dairy industry and changing lending environment. Art has financed dairy businesses in the West, Southwest, and Midwest U.S. for 3 decades with commercial banks and the Farm Credit System. I've had the pleasure to work with Art over the years in mutual dairy relationships. This seminar has been approved for continuing education credits from the American Registry of Professional Animal Scientists and the American Association of Veterinary State Boards, the RACE program. Forms are available in the back if you are interested in the credits. This time I'd like to ask everyone to please silence their cell phones and join me in welcoming Art Mosner from American Ag Credit.
Take it away. Thank you. Everybody hear me okay? Check, check, check. I appreciate the opportunity. Thanks, Jim. Haven't done a whole lot of these, but we'll see where it all rolls. Kind of a broad topic that we're talking about. We're just trying to look at, what exactly is a good relationship with a bank? How do we make it better? This presentation will be about 40 minutes long, about a 20-minute question and answer period to follow. Disclaimer, it's all, anything in here, it's strictly my preaching, no one else's. Probably should be some long legal disclaimer there, but let's keep it simple. Jim went over my background. I've been financing dairies for 30 years, Farm Credit System and commercial banks, mostly on the large size, probably mostly 1,000, 3,000 plus cows. Currently, I lead a team of dairy lenders for American Ag Credit in California. We have operations that we finance in California, Colorado, and Kansas. And also adding my resume for this presentation is my relationship with my wife. And we've been married for 31 years. I figure that's got to add a little bit of value to this overall experience level that I have. We've been going on for 31 years through a lot of ups and downs, cycles similar to dairy bankers and owners. So. A lot of parallels there. The lending process is kind of similar to marriage when you really think about it. We're dating, we're calling on our client, we're asking lots of questions, we're getting to know each other. We're kind of in a discovery phase. Can we work together long term? We're all trying to evaluate fit. Then if we kind of get past that phase, we move on. It's time to meet the parents. In that place, we usually put together what we call a pre-screen or pre-flight memo. It goes up to our senior management discussing, if this is a deal we'd like to do, and can you get on board with it? So the management gets in the mix, and we agree that that's a good fit. Let's kind of move forward. And then we make a proposal, and then we can move that on into a commitment. Then we got wedding day. We have loan closing day. We're consummating our relationship. After all this work of dating, meeting management, we've had a conversation, we've done proposals. Now we're finally to the stage where we can get the deal done. But of course, the only difference is we've got a prenuptial agreement, written contract secured by most of what you own. A little bit different from marriage. So we celebrate our new life together. We have a honeymoon period. Everything's going great. We all on the same page. We're happy with all the steps in the process, kind of where we're at. Then time marches on. We have an anniversary, test relationship, milk price, high feed costs, some kind of industry dynamic, herd health issue. And then we kind of have 3 different ways we can come out of that testing relationship. We have a stronger relationship where we've worked through that period of bad time, low milk prices, say 2009, you know, we've kind of helped each other out, get through that, and we got a stronger relationship going forward. We're now ready to tackle the next hurdle in our relationship. Or we're gonna have a stressed relationship. You know, we didn't see eye to eye through that, but now, you know, we're gonna have to work through it. It's gonna take some time to heal it up because we made it through 09 or whatever that event was, but you know, it's just, our relationship needs, and we got divorced, right? We can either go our separate ways because we just don't, it's not working. As soon as I heal up, I'm going to find another lender because I've decided this isn't where I want to be. Setting the stage, you know, dairy business has share risks, and we're all aware of that. You know, we've had a financial crisis, we have low milk prices, droughts, blizzards, losses. You know, we had a dairy bank failure, a New Frontier Bank fiasco in Colorado. You know, we've seen co-ops rejecting milk shipments now, and we have oversupply situations in certain geographies, and that volatility will continue. You know, right now, kind of the eyes are on, we got a lot of milk in the country. You know, what are we going to do with it all? You know, we're kind of relying on export markets to absorb all that surplus. We hope it's all going to work out. You know, we're all kind of banking that that's the wave of the future, but no one really knows. You know, we've kind of seen that ebb and flow over the years. We don't really have a good government safety net. You know, the CWT, or the margin protection program, hasn't been great. You know, we don't really have a clean way of hedging milk prices to mitigate risk. You know, we're seeing a gradual reduction in small dairies, volatility. 2014 has kept a lot of folks rolling, built up a lot of equity over that time period, and a lot of folks have been working off that equity over the last few years. So the odds of that seems to me like to be a pretty, we can't count on it, and the odds are pretty low. And black swans, we just don't know what's going on in the world. You know, look at what's happened in Las Vegas, right? I mean, international market volatile, the world's volatile. We just don't know what's next around the corner. Therefore, you know, it's critical to have a good relationship with your banker. I put together a couple audio clips.
Hi, Steve. This is Art Mosner from Dairy Bank. Just want to let you know that I reviewed your last cattle and feed barn days, and it shows that you're out of margin. This is a violation of Section 6.2 of our credit agreement. Therefore, I'm going to have to mail you a notice of default. In the meantime, because of the out of margin position, I need to freeze your credit lines until this problem is resolved. Let me know when you can give me a plan to get back into compliance. I can reach to 209-202-2999. Thanks.
So, you know, got a relationship? You know, obviously not, right? I mean, we got issues. This banker is black and white, no flexibility. It's by the book, kind of hardcore. Some of the blindsided, lack of communication. So, kind of to counter that, to give you an idea of what you consider to be a good relationship.
Hi, Steve. This is Art for the bank. Just took a look at your last cattle and feed barn days, and showing that the dairy's out of margin. No need for alarm. We thought this might happen when we met last quarter, given how low milk prices have been over the last 6 months. I know that future milk prices look brighter. This problem should resolve itself over the next few months. However, after thinking about this, I think we should move forward with the plan we talked about a few months ago to refinance your farmland and use the loan proceeds to get your borrowing base back into compliance. This also provides some borrowing cushion and help you sleep a little better at night. I had the real estate loan pre-approved, thinking we may be headed this direction. You agree this is a good idea, lower the appraisal and start the loan documentation process. Please give me a call when you get a chance. Talk to you soon. Bye.
Right. I mean, that's a proactive lender. You know, a lot of compassion, communication, forethought, planning, understanding. And that's on your. Some takeaways from this presentation. You know, hopefully you'll appreciate of the dairy owner relationship. Give you a little insight into dairy lending product. Identify information that's important to dairy lenders. Discover how to impress and impress not impress your banker. Add tools to your tool belt to build banking relationships. Maybe there are some common pitfalls of dairy owner and dairy banker relationships, and hopefully you'll kind of conclude that there's a lot of moving parts to these relationships and not just as simple as a normal vendor relationship with a supplier. Relationship to be successful, need all the basic components of a relationship. We need honesty, trust, and integrity. You know, anytime that's violated in any lending institution, typically you're transferred into a special assets department, and it's all downhill from there. Speak the same language. You know, this is a very specialized industry. We got to understand all the terms and how it all works. To, you know, going on and off BST, 3 times a day milking, all those things that we have. You need to have and what you're doing. Kind of in the same perspective as starting to speak to someone country at the coffee table that doesn't speak your language. I mean, your relationship's just not going to go anywhere. You're see each other's perspectives. You know, every dairyman seems to be a little bit different, just like we're all unique beings and individuals. We don't always agree on each other's perspectives, but we need to kind of be at least compassionate about where each other's at and be flexible. You know, we come up with solutions to problems and we recommend them, but it's not always the perfect solution, and it might not fit what you think. So we'd have to have some flexibility. Relationships are real easy when everything's going smooth, right? It's when you encounter that twist finds your relationship with your banker. You know, 2009, you know, you have some hurt health issue, something happens in your operation, which is going to bring you both to the table to kind of see where you all stand. And I would argue the dairy owner and dairy bank relationship is a little different. You know, we got millions of dollars involved. You know, it's not easy to change. You can't just pick up the phone one day and say, I'm going to go to another lender. We got to start the dating process over again. There's a lot of lead time. It's a special. There's a few players in the industry, so you know, a short list of lenders with different ideas on appetites for the dairy business. And we've got emotional dreams and livelihood are involved. I mean, what's more important than having the money to pay your bills, right? And get your kids in the business, and there's just a whole lot more there than by having that banking relationship in place than, you know, having a new supplier supplying, you know, teat dips or whatever, right? Banking experiences through years, we've seen good, bad, and ugly. You know, we have relationship builders, good experiences, expansions. Everyone loves expansions. You know, dairy bankers, we all love to together. Fun part. You know, we put the financing together. We have that 12-month lead time. We can watch the construction progress come together, see the new project. It's all on plan, assuming it's all on plan. And you know, it's kind of a bonding moment that, you know, we kind of work the whole project and now we see it in real life. It's the next generation. You know, watching the kids come into the business. You know, watching dad step aside, watching that new generation be successful is always a big relationship builder. In recovery, we got like a 2009 scenario where we see someone make significant adjustments in their operations and get the thing back on track. Then you know, that's that relationship. And in 2014, you can't help but build a relationship because it's life, right? Relationship stressors. Anytime on the bank side, things change. You have bank management change. You have a relationship manager change. You have a merger. You know, there's always sensitivities to what's coming out of that. Is the new management regime going to carry on the same philosophies as what we had before? Is that new relationship manager trained well enough to step in the shoes of my old relationship manager? And then bank mergers, you know, you always just wonder whether the new management sees eye to eye with the new institution. You got some moving parts there. Problem loan departments, anytime we see relationships shift over from a kind of conventional relationship manager to a problem loan department, you know, that just kind of cuts the cord. Even though lenders can try to face it the way they want to, you know, you're breaking the tie, and new people, and usually a new agenda. Down cycles, low milk prices, high feed costs, self-explanatory, any unforeseen. And 2.9 is a relationship stressor because we just don't know how long this thing's going to last. Any kind of major downturn, how long am I going to be able to borrow to get through the storm, and how much is my lender going to be behind me? Ugly experiences, relationship destroyers. You know, lender exiting. You know, I've seen some of this in my career where a lender decides to exit the market. You know, it could happen. You Different lenders have different appetites over time. Lenders downsizing their dairy portfolio. You know, lenders don't like concentration. If they have a specific, a lot of times they want to bring that concentration down. And, you know, when times get tough, they decide, well, you know, maybe I don't want to be at 30% of my portfolio in dairy. We want to target 20%. So let's shave off some of our portfolio. Bankruptcy, you know, it just ends their auctions. Family tragedies, you know, death, divorce, drugs, all those things. You know, you see those over years. You've been in it for a long time. That stuff just happens. It's not frequent, but it just destroys relationships. Family infighting, partners not getting along. You know, fraud and theft in operations. We've seen that. Over-aggressive dairy lending. You know, comes a point in time where someone gets excited about getting into the lending market, comes out with a product that's far above what the normal lenders put as underwriting criteria, and they start booking a portfolio of those types of credits, and then all of a sudden something goes sideways, and they need to find a new lender. Well, they find themselves that they're so highly financed that no other lender can take them over. Well, that's, you know, that's a real predicament. Well, borrowing money from a bank is simple. You know, on this, right? You got the bank will pay Dairyman money. Dairyman pays the loan back. You know, Dairyman's good for the money. It's made pay in time. Got plenty of collateral. So print up paper, deal. It's not that easy anymore. We need to gather all the information, due diligence, you know, all those things that we're going to need, financial statements. We're going to look into inventories. You might ask for some projections, feed appraisals. It's just not a handshake deal anymore. We're going to spend a lot of time. You know, we want to know what you're planning to do with the proceeds, how you're going to pay it back. We're going to look at all the different avenues. And when we're in stages of process of talking to a new, you know, we always have a lot of thoughts in our mind. And we know this dairy industry is volatile. You all remember 2009. You know, we're making big investments, multi-million-dollar investments in your operation, and we have management, shareholders, and regulators to answer to. We still remember the financial crisis, and you know, those have been around. We've all, for quite a bit of time, we've probably seen some had some kind of loan issue, and they got the repercussions of that, even though maybe it wasn't their, you know, 100% their fault. There is a fall guy sometimes, so that's in the back of our minds. And in a borrower perspective, you know, we're asking for a lot of information. You're asking for my family history. You're asking for my personal financial statements, my business financial statements. You know, you're getting really personal. And you know, if I'm going to lay this all out, how do I know it's all be worth my while? These kind of thoughts kind of enter into the head. You might be considering a bank change because your relationship changed. You know that you know, you're just not eye to eye. There's something you think that should be done, doesn't agree with. Or, you know, you've just been ignored. We see a lot of those cases. You know, the banker doesn't return my phone calls anymore. I never see him anymore. So I'm going to start looking around. Back to the marriage analogy. You know, he never talks to me anymore or makes me feel special. Behind the scenes, we're loan officers. You get the application. You put the financials in a program. You work it through the credit approval. It all goes through the same stream. You're the point guy, and you're the one who kind of works that whole way. Now most are what we call relationship managers. So we have a whole team of people, and more complicated, more team concept, more people involved in the process. We have a relationship manager. A lot of times we'll have a credit underwriter. We'll have a credit support person. So behind the scenes, there's a group of people working to put your loan together. The manager spending more time building relationships, and, you know, trying to get a personal touch, trying to develop a new business, trying to be there when you need them, rather than being tied up at the desk, working the deal and buried in paperwork. You know, a loan approval a lot of times, and you know, in the past, your officer would go to, you know, bank president, and he'd sign off on it, and he'd move onward. Well, now we got layers a lot of times inside the financial institutions of approval. You know, we got everyone has a certain delegated approval level, and you have a credit committee. You might have a group of people. So there's a number of people involved in the process from start to finish, not just one person. And we have a lot of energy. One day I can get back to you next day. It takes time and energy to put this all together. That relationship manager's quarterback. He's coordinating the credit officer. He's coordinating with the support people. He's coordinating with management. to making sure you're on board. The whole team is kind of working together to one end. You know, and then banks, you know, their ability to grow is not having that person buried in paperwork. It's basically go out there, get some new business, and make sure your customers are satisfied, make need to prosper. And I think all banks would argue that you know, they're all relationships. You know, they're not selling products, not a vendor. They're selling that relationship. You know, our bankers' goals. You know, we want to nourish and grow and prosper that dairy relationship, create a win-win scenario. And we tell the world about our success. I mean, that's kind of the ultimate compliment. You know, every now and then, some dairyman is willing to step up, a little testimony of kind of what it's done for them, and it's just such an extent where they're willing to go public. I came across this from an annual report, a little lengthy, but I couldn't figure out exactly down, but basically kind of hit the high points. You know, it's a few years ago, changed banking relationship over this bank, and how impactful the ensuing relationship would be for both them. You know, there's dreams, require dedicated financial partner to achieve. You know, the loan officer, the dairyman realized that their intelligence and strategic thinking that his loan officer brought to his work, and the owner was impressed with the loan officer's deep knowledge of the dairy industry. Build a relationship of mutual respect and trust, working growth of that dairy. Never interested in Jim pays attention to what John's trying to accomplish. John knows that Jim's by his side, always listening. You know, it's basically all those things we talked about that, you know, all plus, win-wins for everyone. And, you know, that's kind of where we're hoping that every relationship can get to that point. Relationship building from a lender perspective, good communication, you know, is always critical. Got to answer the phone calls, got to be there where you need to be, got to have the information on a timely basis. Loan agreements require information to be submitted to us within certain time frames. Having that information on a timely basis, it helps out us. You know, we have to internally, we constantly have late information. We have to report that, get approval. Creates a little stress internally. You know, the customer doesn't see it a lot of the time, but in terms of building a relationship with the bank, getting that information to us on a timely basis is important. Preparing a business plan to understand needs. You know, if we have it in writing, where we know, we fully understand what your plans are for the coming year, what financing you need, we can really tailor a lending program to meet those needs. But sitting down and having that in writing is a big plus. No surprises. You know, there's, like we said, we have a big team of people involved in this process. We have a surprise, and we have to share that with the team, kind of figure out, you know, what exactly. Communication, having everything a heads up on something going on, definitely a big plus. Manage and understand milk and feed price risk. With how volatile this industry has been, you know, we're all thinking there's got to be a way we can hedge some of this risk, take some of that risk off the table. You know, we're going these cycles up and down. 1 year big profit, 2 years losses, then back to profit again. There's got to be, you know, is that a long-term model to operate in that manner, or should we have some kind of a better strategy on milk and feed price risk? We're not sure 100% what the right strategy is either, but to at least have that conversation and take some of that risk off the table is definitely a big relationship builder, because we're talking about it behind the scenes. Understanding the credit agreement, you know, where we're at the tail end of a loan, we usually give you a draft of our credit agreement, hoping you're going to read through it and understand what it all means. You know, there is a lot of borrowers that just don't take the time to really review that, and they're kind of surprised when something pops up and we tell them they're in violation of their credit agreement. So understanding the credit agreement that's required of you, that's a relationship builder. You know, 6 months down the road, saying, I really didn't know I needed to do that. You know, that's a tough place to be for both sides. Satisfied with a competitive interest rate. We have certain relationships we get into where that's all we talk about. That's the first thing. I mean, we have coffee and say, you know, when are you going to lower my interest rate? We want to be competitive, but if we're constantly talking about interest rate, and you know, it's a relationship destroyer, not a builder. Listen to the advice of the lender. You know, even though we don't have the right concept, from your perspective, given that given that advice some thought, pros and cons, just that tends to be a builder on the relationship. Knowing numbers, time, analyzing numbers. Financial statements are important to us. We look at trends. If you could stay one step ahead of those numbers, and when you had the banker ask that question, what happened to profitability? Why did you lose $2 a hundred? You can say, well, feed cost was $1 higher, and my operating expenses ended up going $1, and I had this issue and dropped production. Just knowing those numbers gives a big benefit to the lender. And then taking aggressive action when a problem arises. Kind of point to one particular transaction, 2009. We had a client, a prospect, that had a really tough time, a couple years, and he went and liquidated all his 90% of his farmland holdings, took the cash, injected in the operating line, gave him some good liquidity, put him in a really nice financial position. New lender comes on board, looking at that and say, okay, you see, you had a rough patch here, and the industry was not doing well. We kind of understand that. You got your ship righted pretty nice here. You did what we thought was critical to get that cash in here, and that's looked at very positively. That's not always the right action, I guess, but it's looked at very favorably when come to the table for more than just I need another deal back in order. But you liquidated an asset or made some other change, that's looked at favorably. Investing in good accounting information. I'm more the west side of the country. We deal mostly in CPA prepared financial statements. But I would argue that investing in that accounting information is going to be a relationship driver with your lender, gives you a basis to have conversations, and also allows you to compare that information to your peers and to others. From a borrower perspective, just gave this some thought, good communication. Like I said, there's been relationships that have been broken just because you don't answer calls and don't give them the attention. Supply a reliable supply of cash. Can't be on the edge all the time. If I'm running on my line limit and I'm having trouble paying my bills, maybe that line limit needs to be increased. Maybe that loan needs to be restructured. But I need to manage my business, and I don't need to be constantly worrying about being short on my credit line. Lend the amount of capital needed. If I need a 65 or 75% real estate loan, don't offer me a 50%. Do what's risk for my operation. Give me the money that I need to make this successful. Anticipate credit requests. Hopefully you're having good communication with your borrower, and there's going to be tidbits that come out of that, right? I'm going to need a new order this coming year. That my neighbor's going to sell the property neighboring property within the next year. Well, maybe we need to set up an equipment line to get that equipment needs taken care of. Maybe we ought to pre-approve a real estate loan to make sure that you're covered, so when that deal comes up, you're ready to go. Provide competitive interest rates. Obviously, we've got to stay in the market. Understand the cyclical nature of the dairy industry. This thing goes up and down. If you can't live with that cyclicality, I need to find another lending institution, because I know this thing's going to be up and down. I could be 2 years losing money before I make a decent profit. That's just the way this whole thing works. Advise with finances. I'm a dairyman. I'm working on the best I can to manage my herd of cows. You're my financial advisor. I kind of rely on you to give me some advice to get these things financed. Timely and responsive decision making. We get into situations where we get busy, we don't get your lines renewed on time, and we need a 30-day extension. Well, then we need another 30-day extension. Obviously, if we can't get our work done on time, it's not going to be a plus for the relationship. Reasonable terms of financing. You've got to stay competitive. To lay out a lot of paperwork in front of our borrowers and thick piles, but I think somewhere in the middle, there's a reasonable amount of paperwork versus you got to have patience. That goes along with understand this nature. This thing is going to turn around. Be patient. Don't throw me into the problem loan department. I think it's all going to work out. I got a plan to get there. How not to impress the bank. Limit communication, late financial information, violating your financial covenants, drawing excess. If you $200,000, but you drew $750,000 personal withdrawals out, living that always borrowing significant funds of money outside of the business without letting the, typically we have loan covenants for that, but that happens a lot. You know, I had a great opportunity to invest in the company down the road, and so I drew $1 million operating line. You know, we probably need to be in the loop on that. Significant capital expenditures, that kind of goes along with it. Financials with losses without a heads up to the banker. You know, if we get financials, a good set of financials once a year, and all of a sudden we find out that that loss is way over what the rest of the industry's done, well, you know, talk to us about that, right? Let us know give us a heads up. You know, if things aren't going so well, this is paid. It just makes life a lot better. But when we find surprised, back to surprise, it causes issues within the bank. You know, I had another scenario. First quarter, a client had a herd health issue and culled out a bunch of cows, had a bad somatic cell breakout, decided, I'm just going to go ahead and beef out everything that's suspect. Went ahead and beefed out, 25–30% of his herd over a 3-month period. Getting financials and the production's dropping, the herd's dropping. You're like, okay, well, let's wait till the next financial and see what's going on. Don't quite understand it, and finally get to the end of the year, and you finally ask the question: what exactly happened? Why is this thing? Why is production down? Why milking cow numbers down? Well, we had this little outbreak here the first quarter. We went ahead and beefed out 25% of our cows. We went out to the market, them all. Everything's back on track now, but we probably should have known about that, and we had it in our minds, but the customer was, you do sense there's a reluctance out there for the borrower to reveal some of that stuff just because they feel there's repercussions. There's a lot of uneasiness out there with bankers. A few other relationship destroyers. Don't want to put crazy ideas in anyone's head, but these things have happened. Jim C. Moving neighbors' cattle in the corrals, for appraiser ride, piling manure under plastic covers, center of haystacks empty, cattle on pasture in a different state, where there's someone else's cattle. Say you go in a calf ranch, but you do not own them. All that stuff has happened, unfortunately. That goes back to integrity and honesty in the relationship. I think our relationship has been challenged by, bankers change employers more frequently. I think most people would probably had more. That probably was the case years ago, where they kind of grew up with them in their operational relationship with the family. Bankers just tending to change frequently. I'm on that same page. That's the way we further our lives and that's the way the banks have kind of set things up to, for career growth for bankers. Changes in the banking industry, especially in commercial banks, they've been under a lot of financial regulation. You have the Dodd-Frank deal because of the financial crisis. They're overseen incredibly by internal regulators, external regulators. So everyone's looking over their shoulder a little more. Dairy lending has increased. We've seen a lot more volatility. It's not as stable as it used to be. We have greater reliance on electronics for communication. I got a lot of clients that go on text and emails. Love the text and emails, but it kind of takes a little bit of the, it just doesn't replace being at the coffee table and talking about where we're heading next year and your operation. And I just say lack of a banking story. They've around with someone in the dairy business a long time. Some of them have that story about, back in 1945. This banker that I'm with has, we had this issue. He stepped out and he took care of this. He probably shouldn't have, or he probably, didn't inform his management. But he really helped me out, and I'm staying with this financial institution as long as he's going to be around because he's kept me in business. How important is your life? I would argue very. After your spouse, children, relatives, that's critical to your dairy operation in times of hardship and expansion. You got to have a banker. You can't be short of cash. I think anyone's been on the edge of realizes being short of cash. That's a stressful experience. You're stretching out your vendors. You're managing your operation to just to kind of get through day to day. If you have the right banker and the right relationship, you're able to get through these storms a little better. And lender has several methods of dealing events of default. And you got all that paperwork and all those credit agreements, and there's like 2 or 3 pages, right, of what are the remedies on default. Well, you can call the loan due, you on your collateral, all those ugly things that a bank can do. If we have a good relationship and the communication lines are open, we're gonna waive that, we're gonna extend it, we're gonna modify it. But if we're in a real tough situation and we're not seeing eye to eye, the bank do have the right to what's shown on the black and white. Expansions are getting bigger, require more borrowed capital. Are, you're talking $5,000 plus a cow, on a fourth cow, $20 million just in real estate, and then you got your cattle, you got your equipment, you're talking $50 million. I mean, it's big money. So far beyond the means of what a normal dairy can generate out of their profitability. So being positioned and having the right lender for those big expansions is pretty critical. Talked about banking relationships, make or break it during the industry down cycles. And when times get tough, there are not a lot of bankers around. 2009, when times were tough, a lot of folks were shopping around for banks, and everyone pulls in the reins at that time, right? It's not the time to be looking for a new bank. Everyone wants you to wait 12 months, get a little performance behind your belt, and then we'll take a look at it. We'll hopefully put your ship on the right path again. But in the meantime, if you're in a tough situation and you need your banker and you can't find a new banker, it's just a tough place to be. Your banker is a conduit for your relationship. We're the messenger. We consider ourselves kind of be your financial caretaker. We advocate for you within the management. Tell our management that we were truthful. And most of the time, we're going to be on your side. If the relationship's good, and then we're free, except for fees and interest. How a dairy lender adds value. We advise financing structure, which works best for you. We're kind of evaluate what you're looking at doing and give you kind of a plan based on what our experience has been on structuring similar deals. We have feedback from other clients. Maybe that new manure. We might have had 2 other clients that have tried that out already, and maybe we financed it one way, maybe we do it a different way. So we have access to a lot of client information. We have access to a lot of financial information on a confidential basis. We do kind of a lot of times do a benchmarking of how your operation compares to other operations, and we could share some of that information on a global basis with our clients. And we understand what our limit credit structure can sell with our management stream, get your deal done. And for the old timers like me, maybe Jim, we've learned some lessons from past experiences. We've probably lost $1 or 2 in the industry, and we advocate. We try to balance that need for your favorable terms. We want the best for both parties. Politics through the credit approval stream. There's a lot of people involved that we have to bring to the table to get things done. Some deals more than others. We connect to capital for other banks. Things are getting so big that bring a lot of times. We got a network of folks that we work with that we know would be a good fit for your particular operation. Explaining a tough situation created by unforeseen events. If something happened in your operation, we want to be there to be able to explain that up the management stream. I mean, if we have the right communication and a good relationship, to work through those situations. And you kind of step back and you look at it, there really are very few banks financing large dairy operations. And why is that? Well, a lot of these things we touched on. Got industry cycles more frequent. You got volatility of these milk and feed prices. Some lenders have had loan losses. Up to prior to 10 years ago, I wish I could have carried that for the rest of my career, but I got stung like probably everyone's got stung. Government oversight requirements. There's just a whole lot more regulators, auditors that commercial banks. I'm not trying to bash the commercial bank. They have a lot more avenues to put their money, right? They got a portfolio. They got real estate loans, auto loans, small business loans. Might not be on the top of that list. It's just a segment of their portfolio that they can easily pull out and move it into another pocket. Again, it's kind of a summary, why. A little control over price. Months in duration. I'm in California right now. We've seen a lot of operations with 2 consecutive years. Volatility. That's kind of a common theme. In a perfect world, ideal scenario, we want profits every year, not a profit every 3 years. We got a really steady ship going for a lot of years, and now we got milk prices going up and down, yo-yo. That shouldn't be a surprise. Profitability over several areas. It's up and down. It's just unstable and volatile. Over my career, there's probably been, I kind of put the relationships I've had in 3 different pockets. You have a transactional relationship, a productive relationship. Level 1 would be just customers. I got it covered. Just give me what I want, right? I really don't need much from you, bank. I have it. I got it covered. My line and work on down the road. Productive relationships. That's kind of where we all want to be. The sweet spot. We want to be on behind the coffee table with you, talking about your operation, helping you out. Really sees value on both sides of that relationship. And then we have an adversarial relationship, and there's those folks that just maybe they had a bad experience sometime with the bank, but they're hands off. They don't really want to talk to you or see you, but even though they need you more than the next guy. And a lot of that's driven by financial strength. That level 1. They really don't borrow too much. At times maybe they're lending you money. They got money on deposit versus you lending them a lot of money. They're very financially strong. They got multiple lending sources. You may have a CFO that gives the finances a lot of attention. That kind of takes the place of the banker. Level 2, that's kind of where we talked about. That's where most of our relationships are. Moderate level of borrowings. We see great value in relationships. And that 3rd tier, they borrow a lot of money. They struggle every time there's a downturn. They're kind of on the edge, kind of uneasy about the banking relationship. The reality is that level 3 tier, when times really get tough, and when that relationship rubber needs to meet the road, they're the ones that are going to be not benefiting the most from the relationship. I just thought behind the scenes, we're talking about a lot of terms, and we talk about communication and what are bankers looking at. These are kind of a little bit of a vocabulary, I guess. We talk about cash flow. You can get a lender come talk to you with a bunch of bankerese, right? Hey, you had negative cash flow. Your liquidity went down. Your leverage went up. Your burn rates dropped. It's like speaking foreign language. But this is kind of a common vernacular, I guess. A cash flow. What kind of cash you're generating to cover your living expenses and debt service. Profitability, cash flow, kind of the same idea. Liquidity, what do you got? What do you got that you can get to cash real quick, right? Most of the time we get an operating line based on cattle and feed, and you got an operating loan balance. You can borrow, we get a borrowing report and it shows you can borrow so much money on those assets. Well, that's what you can tap quick, right? That's what your liquidity is. That's what times get tough. You're gonna borrow on that operating line to get you through the storm. Leverage, can the dairy handle the amount of debt it has? Higher level of debt is higher risk, right? Leverage being, we want, ideal scenario would be a 50-50, right? 50% of your assets we've lent you money on, and 50% you own. Nice balance. A lot of times we'll go to 35%, where you have 35% in, we have 65% in. Those are kind of common scenarios. The higher the risk, that lever as it changes, more debt, less equity, less you have in there and more we have in there is more risk. We talk about burn rates. How long can the dairy sustain a period of losses such as 2009? If 2009 you lost $2 a hundredweight and you had $3 million of margin in your operating line, and you lost $1 million, you got $3 million, you got 3 years that you can burn, right? 3 years of burn rate that you can work through to get through that storm, versus someone who may have $1 million of borrowing-based capacity, and their burn rate is $1 million. million where they only got 1 year. So, you know, we like to see that you got some room to maneuver, especially given the volatility in the environment. And it's kind of all these things kind of play into each other, right? You got, you know, if you don't borrow so much on your operating line, you got high burn rates. You know, you don't borrow so much, you got low leverage. Borrowing base margin being the kind of the difference between what you own in cattle and feed and what you owe on your operating line. You know, it's kind of that, it's what you got to work with. Secondary support, you know, not only on the cattle and the feed we look at, we also look at real estate and other investments. And what do you got out there that you can tap to generate cash in a bad situation? Can you refinance real estate? Can you liquidate an investment? What can you do to bring cash into this if, you know, in case your borrowing base is depleted? And debt coverage, we talk about, you know, it's another measurement of how profit / cash flow ability to cover your debt. You know, cover it 1-to-1. You made enough money to cover what you have in principal and interest payments. You know, versus you know, only covering half or a fraction of what you have. Ideas to improve bank-borrower relationships. You know, understanding the bank's lending policies. You know, every bank has policies and procedures of what they're doing. You know, you kind of understand how you fit into all that. You know, what is the maximum amount that you'll loan on feed cattle and equipment? You know, so I understand what the parameters are. Where will you tap out on your borrowing? What's their legal lending limit and internal lending limit? You know, every bank has a certain limit of money that they can borrow internally, lend internally, both from a legal point and from a management point. So, you know, if you're creeping on those edges, then a lot of times they have to find a participant. You know, you need to understand how that arrangement works. You know, if they're bringing in 2 or 3 other lenders, you know, who are they and how do they fit into my deal? And then everyone in that has a certain lending authority, relationship managers, credit officers, management, understand where how far does this thing have to go? Does this go all the way to your credit committee, or does it just go to your direct manager? All those are kind of good things to know, and you kind of understand the inner workings a little bit of the bank. And what kind of loans does your institution prefer? There's some commercial banks, they just like operating loans. They don't like real estate. Some like to do operating loans and real estate. So, you know, where do you fit into this whole equation? Do you like to do the whole thing, just a piece of it? All good things to know. You know, understanding the information you're supplying to the bank. You know, how that borrowing base is calculated. You know, a lot of times we get on larger operations monthly inventory, cattle and feed, borrowing base certificates. Having those accurate and knowing how everything's calculated is critical. You know, what is profitability per hundredweight per cow? How are financial ratios calculated? You know, all that stuff's important to the bank. And then any major changes. You know, if you get a borrowing base report in and it shows you went down $200,000 in borrowing base margin, what drove that? Was it losses? Was it some money that exited the business? What exactly is going on? It's a whole lot better to kind of communicate that to the bank than have the bank call you and ask you the question. Same with profitability and you know, equity position. You know, your equity went down by $500,000 last year. What drove that? Is it losses in the operation? Money withdrawn somewhere else? What exactly is going on there? Being one step of a relationship manager. You know, if you understand what he needs and wants, you know, by you being kind of one step ahead of him, you know, when you submit that report, you know what it shows. You can kind of communicate to him, send him a note. Hey, you know, got my next quarter financial statements coming up. You just need to know that, you know, I'm going to show a 50-cent a hundredweight loss because, you know, milk prices just weren't there and my feed costs went up a little bit. Just something that shows that you got some skin in there and you've taken a look at it, and that just adds to communication and confidence in the relationship. Providing an annual business plan. You know, if you can kind of recap the last year, you know, where the dairy stands today in terms of just overall operations, what plans you got going on for the coming year, what credit needs are you expecting? Kind of take a look at the line sizes. Do they all make sense? Is there something we need to change? Again, being kind of proactive with the lender. It's only going to benefit both sides. And then just to throw a side in there that certain size, probably pays to have a controller, CFO type on staff. You know, we see all different categories from kind of a advanced bookkeeper to CFO level to handle the finances, just because at some point in time it's creating a lot of time and energy out of your operation to submit all this information and to stay on top of it. You might ask, how's the dairy lender? My dairy lender, is he the best fit for my operation? Oh, just a couple bullet points of things to think about. How concentrated is that lender in the dairy industry? Concentration is a big issue in finance. You just don't want to have too much in one bucket. So, if it's heavily concentrated, we saw that in New Frontier Bank in Colorado. If anyone ever isn't aware of that, Google that sometime and look at the story. It's quite an interesting story of a bank rising out of the ground, starting in the dairy business, getting over aggressive, and kind of basically falling under FDIC liquidation. That was a case where they hit huge concentrations in dairy business. So when build a big portfolio of dairy and then you hit it the wrong time, industry goes down, you got a bunch of problem loans, you got regulators all over you, and then the whole thing just kind of falls apart. How did that lender react in the past 3 industry downturns or 2 industry downturns, whatever it is? Did they work with their borrowers? Did they send those borrowers to a problem loan department? Did they pay back? Were they patient? All those things are in today's environment are kind of critical. What's the industry reputation of the lender? You can ask around. There's a lot of supporting industries. There's feed dealers or CPAs. I'll give you a lot of input on what that particular lender is doing in the marketplace, and they can answer some of these questions about how did they react in the last few downturns. On the subject of kind of annual business plans, there's another form I just kind of throw out there that's kind of what we've been doing in some cases. It's more of what we call, rather than a business plan for you, from you to us, it's more of a us to you, from the banker side, review of where we're at in the relationship. We could basically sit down, similar to a business plan, but from a banker's perspective. What do we see in your financial statements? What trends are we seeing? Here's a summary of the credit facilities we're providing. What products are working and what aren't working? What new products do we need to provide? What have we accomplished over the past year together? What are our goals? Kind of give a synopsis of interest rates. And then how can we both improve our relationship? Getting back to communication, working together, being proactive. So the business plan on your side, the relationship review on our side. We can kind of compare notes a couple times a year and make sure we're all on track for prosperity here. Let's see if I can get that up here real quick. It's the 30 years. So just like a business plan, it's you kind of give an overview of what your institution, highlights kind of who your team is. It's kind of everything in one spot. In this case, we're talking about Farm Credit System, who we serve, get a little organization chart, talk about credit facilities, kind of lending highlights. Who are all these people? We talk about a team of people working behind the scenes. Who are they and how do they interact with my deal? There's an opportunity for some of those to come to light, maybe come out in a meeting with you to see who is the credit officer, who is the support person, who are some of the management people. So you got kind of more of a big picture view of who's involved with your relationship. And we talk maybe some borrowing base and financial trends, some financial and operation highlights. Maybe just in comparisons to industry average. How are you looking compared to, there are a lot of CPAs prepare industry average information. We can kind of take a look at where you're at compared to them. And then we look at some other products, maybe talk about some risk management, kind of review interest rates. So that's just a tool, just kind of share that with you. I think that's kind of the end of the show here. That's running out of time. Be glad to answer any questions.
Yeah. Thanks, Art. Hey, let's open up for questions. We've got some time here for questions here. Let me bring the mic back for us. Hey,
Yeah, same here. Nathan, right? Yep.
I thought your analogy of a relationship and a relationship can hit stress at times was a good one. And those stressors, there are some that are specific to the borrower's business, there's some that are kind of specific to the market. And then I thought it was really helpful if you talked a little bit about the stressors that can exist on the lender's side. So imagine you're in a borrower's shoes, times are good, you're shopping for a new loan, you actually have an opportunity to shop among lenders. How would you suggest someone do due diligence on potential lenders in order to assess whether when times get tough or difficult, there will be those bank-related stressors that might emerge? Relationship managers leaving, management turnover, mergers, these are all things that are pretty difficult to predict from the borrower's point of view, but really can be the difference between a good relationship and a bad one in a difficult time.
So how to evaluate a bank when times are good, whether it's a good fit? Well, what you're going to find when times are good, it's fairly typical in the banking industry. You probably have multiple proposals with a lot of good terms. That makes it tough. It also, the other challenge for the existing lender who has that relationship for a long time that we get involved with is, now we got this massively competitive market when times are good. And, we're having to cut rates. We're having to give more flexible terms, which we feel is not probably outside the marketplace, but this is what, the competition's doing. So do we match that, or do we sell ourselves on the value of how we've worked with folks during tough times? I think we hang our hat on that a lot, but it is a tough situation. I think from a borrower's point of view, it's easy to get blindsided into that. If you're getting an offer for a 0.5% better rate and more liberal terms, it just seems like that's maybe I should go with that. But I would argue that there's a whole lot of value in that long-term relationship, because that deal you got might not be there in 2 years or 1 year. Whenever the line renewal comes up, it could just be a factor of where things are at that particular time in the industry. So I'd go back to the same, evaluating, how are things handled in the last 3 downturns? What's the reputation? I guess those would be the fallbacks, and what is that worth? We've had situations where we have to basically say, we can't match that rate. We have a scenario right now, as a matter of fact, where we don't feel like we need to go where the competition's going, and we feel like we're worth it. It's a tough gamble, right? But you don't want to set the you don't want to create a new market pricing or terms in in not so great a market the way we are right now in the dairy industry. And then we also kind of look at what our other portfolios doing. We want to keep a balanced portfolio where everyone has a fairly reasonable, uniform terms of their banking relationship. We don't want one to have a rate down here and the next one up here. Has got to be kind of a balanced medium, because that's only fair to the rest of the people in your that you're financing. That answer the question? Okay.
Other questions for Art? Art, one of the things I thought about is, we've got most of our dairy farm operations we work with have multiple generations of family members in there, and that's always, both from the lender standpoint of how we're making sure we're connecting with all those family members, both family that they're working with, their banker, lender. Any suggestions or observations on how both sides can improve that connection to both to all the generations that might be involved in the operation?
Increasing the connection between the younger generation and the older generation.
Just in terms of making sure that the lender relationship doesn't extend, which a lot of us times we grow up with a senior member, have sometimes connected with
Right.
the next generation, and making sure that we're doing that, and that the farm family is also
Sure.
doing that for us.
Well, I think getting the next generation involved in the financing discussion early is critical. And even if you're sitting in on the banker meetings, I know I've had clients that are kind of hesitant to bring in the next generation to kind of explore what's going on the finance side. They just don't want, they want to keep a distance. They're not quite ready to divulge everything that they have and kind of where they're at. But I think bringing them in early to discuss kind of where they're at and what their position is and what the banking looks like, and kind of educating them on the banking process can only benefit the younger generation earlier rather than later. I don't know what I've seen lately. I mean, I've seen partnerships on the operating, and then the parents have maybe ownership on the real estate side, and the partnership or LLC leases the facility from the parents. I don't know what those are kind of a vanilla deal I've seen in recent years, but I don't know if a lot of trust type relationships. I don't know if you've seen anything else in terms of how a lot of those are getting structured out here.
We're going to take a look at this 550 cow dairy, which is run by fourth generation Brian Foust, his wife Wendy, and their family. The fifth generation is coming, and yet to take their place in the history of this very, very excellent herd. With that said, we're going to get started here. And any questions? We're going to take any questions towards at the end of the talk. And if you got a question, raise your hand, and I'll get around with the microphone, and we'll get started.
Appreciate Art taking the time to join us today.
When I was 8 years old, I was driving a tractor already, but different tractors than today. But I was cutting hay already and all that. I mean, I never had anything else.
Brian and Wendy have built a tremendous herd of cattle, and